What would you do if you walked into your regular grocery store tomorrow morning and discovered that half the shelves were completely empty? Not because of panic buying, not because of a delivery delay, but because the warehouse that supplies your entire region literally ran out of inventory. You'd probably start wondering what else might be running out. And you'd probably start paying attention to things you took for granted yesterday. That's exactly what's happening right now in the silver market, and most people have absolutely no idea it's unfolding. Right now, at this very moment, the Shanghai Futures Exchange holds approximately 429 tons of silver in its registered warehouses. That number might sound impressive until you realize something startling. Just 3 months ago, in September, those same warehouses reportedly held around 715 tons. The inventory has crashed by roughly 40% in 90 days. We're watching one of the fastest physical metal drawdowns in modern commodity market history. And it's happening while industrial buyers across China are desperately trying to secure supply for production lines that cannot stop without causing cascading failures across global supply chains. December typically marks the final push for manufacturers trying to meet annual contracts. Solar panel producers need silver paste for photovoltaic cells. Electronics manufacturers need silver for circuit boards and components. Automotive suppliers need silver for electric vehicle systems. And all of them are watching the same inventory numbers plummet week after week, knowing that if the Shanghai Futures Exchange runs dry, premiums could explode overnight. Some market observers are now projecting silver could hit between $65 and $70 per ounce before the end of December. Not next year, not in 6 months, within the next few weeks. Let me walk you through what's actually happening beneath the surface. Because this isn't speculation, this is based on exchange data, shipping records, and purchasing patterns that are publicly available if you know where to look. Here's something most people don't realize about silver. It's not like gold. Gold sits in vaults as a store of value. Central banks hoard it. Investors collect it. But gold doesn't get consumed in industrial processes at anywhere near the rate silver does. Silver is different. Silver gets used. Photovoltaic solar cells require silver paste because nothing else conducts electricity as efficiently at the microscale needed for solar energy conversion. Every single solar panel installed anywhere in the world contains silver, and solar installation rates are accelerating at a pace that would have seemed impossible just 5 years ago. In 2024, China alone installed over 250 gigawatts of solar capacity. Each gigawatt requires roughly 1 million ounces of silver. That's approximately 250 million ounces consumed just for Chinese solar expansion in a single year. But here's what makes this fascinating. Global silver mining production in 2024 totaled around 830 million ounces, according to industry surveys. Solar demand alone consumed nearly 30% of global mine supply. Add in electronics, electric vehicles, 5G infrastructure, medical applications, and traditional uses like jewelry and silverware, you're looking at industrial demand that exceeds mining supply by a significant margin. The deficit gets covered by recycling and by drawing down existing stockpiles. Which brings us back to Shanghai. Those warehouses aren't just shrinking because China is using more silver domestically. They're shrinking because China has been exporting massive quantities to relieve supply pressure in London. In October, China reportedly shipped around 660 tons of silver in a single month. That's the highest monthly export volume on record. Why would China, which needs enormous amounts of silver for its own industrial base, suddenly export 660 tons? Because London's vaults were approaching crisis levels. The London Bullion Market Association publishes vault inventory data. Those numbers have been declining steadily throughout 2025. When London inventories drop too low, the entire global pricing mechanism becomes unstable. London serves as the primary hub for international silver trading. If London runs out of deliverable metal, the paper contracts that determine global silver prices could face what market participants call a squeeze. That's when contract holders demand physical delivery and there isn't enough metal available to satisfy everyone simultaneously. To prevent that scenario, silver had to flow from Shanghai to London, fast. Some shipments were reportedly sent via air freight. Let me emphasize that. Silver is heavy. Shipping costs matter enormously for a metal this dense. Under normal market conditions, nobody air freights silver because ocean shipping is vastly cheaper. When traders start air freighting silver, it typically indicates one thing. The buyer cannot wait 2 weeks for ocean transport. They need metal immediately, and they're willing to pay premium shipping costs because the alternative, not having the metal at all, is worse. Lease rates tell the same story. Silver lease rates measure what it costs to borrow physical silver for a specified period. When lease rates are low, it means metal is readily available and lenders are comfortable lending because they're confident they'll get it back. When lease rates spike, it suggests lenders are nervous. They either don't have metal to lend or they're worried about getting it back if they do lend it. In late 2025, silver lease rates in London reportedly hit 39% annualized. That's not 3.9%, that's 39%. Those are crisis-level rates that typically only appear when physical supply is genuinely constrained. Now, here's where this gets really interesting for anyone paying attention to geopolitical trends. Russia just announced approximately $535 million in planned silver purchases over the next 3 years. Russia doesn't need that much silver for domestic industrial use alone. This appears to be strategic accumulation. When governments start accumulating physical commodities, it usually signals one of two things. Either they're preparing for currency instability and want hard assets, or they're positioning for geopolitical leverage in critical supply chains. Silver has recently been designated a critical mineral by the United States government. Critical mineral status isn't symbolic. It means the government considers silver essential to national security and economic stability. Once something gets critical mineral designation, it becomes subject to potential export controls, import tariffs, and strategic stockpiling programs. The United States currently imports approximately 64% of the silver it consumes. That creates a vulnerability. If foreign suppliers restrict exports, or if trade relationships deteriorate, American manufacturers could face severe supply constraints. Section 232 investigations have been initiated. These are the same trade policy mechanisms used to impose steel and aluminum tariffs in previous years. Estimates suggest potential silver import tariffs could range from 15% to 50%, depending on the specific policy implementation. If those tariffs materialize, the effective cost of imported silver for American manufacturers increases immediately. That creates precautionary buying. Companies that might normally maintain 30 days of silver inventory suddenly want 90 days or 120 days. They're willing to pay higher prices now to secure supply before tariffs potentially make it much more expensive later. This kind of precautionary buying creates a feedback loop. Rising prices trigger more precautionary buying. More buying draws down inventories faster. Faster inventory drawdowns trigger even higher prices. The cycle reinforces itself until either new supply comes online or demand destruction occurs. Demand destruction means prices rise high enough that industrial users find substitutes or reduce consumption. But silver is difficult to substitute in many applications. Solar panels simply don't work as well with alternative materials. Electronics require silver's unique conductivity properties. Medical applications depend on silver's antimicrobial characteristics. There are some applications where alternatives exist, but in many critical uses, silver cannot easily be replaced. Let me share some historical context that most people never learned in school. In 1965, the United States stopped minting silver coins for circulation. Quarters, dimes, and half dollars had contained 90% silver for decades. The reason they stopped wasn't symbolic, it was economic necessity. Silver prices were rising, and the melt value of the coins was approaching their face value. People started hoarding pre-1965 coins because the silver content was worth more than the denomination stamped on the coin. The government couldn't allow that to continue without risking a currency crisis. So, they switched to copper-nickel-clad coins almost overnight. That decision created an interesting secondary effect. All those pre-1965 silver coins that people had hoarded started entering the recycling stream. For years afterward, recycled silver from old U.S. coins provided a significant source of supply for industrial users. But that supply has largely been exhausted. Most of the easily accessible numismatic silver has already been melted down and recycled. The secondary supply that helped balance the market for decades is diminishing, which means mining production and new recycling streams need to fill the gap. And they're not keeping pace with demand growth. Here's something fascinating about mining economics. Silver is rarely mined as a primary product. Approximately 70% of silver production comes as a byproduct of mining other metals like copper, zinc, and lead. When copper prices are high, mines increase copper production and silver production rises as a side effect. But when copper prices fall, mines reduce production and silver supply contracts even if silver prices are rising. This creates unusual supply dynamics where silver production doesn't respond quickly to silver demand signals. Opening a new silver mine takes years. You need exploration, permitting, environmental assessments, financing, construction, and commissioning. From discovery to first production can easily take 7 to 10 years for a major mining project, and most of the high-grade, easily accessible silver deposits have already been mined over the past century. New discoveries tend to be lower grade, in more remote locations, or in geologically complex formations that are expensive to extract. All of which means that even if silver hits $70 or $80 per ounce, new mine supply won't materialize quickly enough to relieve a near-term squeeze. Industrial users understand this dynamic. They know supply is constrained. They know inventories are falling. And they know that waiting could mean production disruptions that cost far more than paying elevated silver prices today. A solar panel manufacturer that runs out of silver paste doesn't just lose one day of production. They lose customer contracts. They face penalties for missed deliveries. Their reputation suffers. For a company like that, paying $70 per ounce for silver is vastly preferable to paying $58 but not being able to secure supply. That's the psychology driving what some analysts are calling industrial panic buying. It's not irrational. It's completely logical behavior when you're staring at declining inventories and production deadlines you cannot miss. The panic isn't emotional. It's calculated recognition that the risk of not having material outweighs the cost of paying elevated prices. And when multiple industrial buyers reach that conclusion simultaneously, prices can move very quickly. Now, let's talk about what market technicals suggest is happening right now. Silver recently broke through $59 per ounce, setting new all-time nominal highs, but it's currently consolidating in the $58 to $59 range. Consolidation after a strong move isn't weakness. It's typically a pause before the next leg higher. Traders who bought earlier are taking some profits. New buyers are waiting for confirmation that the move isn't done. And industrial buyers are continuing to accumulate regardless of short-term price fluctuations, because their need for physical metal doesn't stop just because the chart is consolidating. Volume patterns tell an interesting story. Exchange data shows that physical volume, the actual movement of real metal, has been increasing significantly. Paper volume, the trading of contracts that may never result in physical delivery, has been increasing too, but at a slower rate. When physical volume outpaces paper volume, it typically indicates that real users are driving the market rather than speculators. That tends to produce more sustainable price trends because the demand is rooted in actual consumption rather than leveraged bets. Let's look at what $70 silver would actually mean in historical context. The all-time nominal high for silver was approximately $49.80, set in January 1980 and matched again in April 2011. But nominal prices don't tell the full story. When you adjust the 1980 peak for inflation using the Consumer Price Index, that $49.80 would be worth approximately $178 in today's dollars. Measured against that inflation-adjusted benchmark, silver at $58 or even $70 isn't historically expensive. It's still deeply undervalued compared to the purchasing power peak set 45 years ago. Some analysts point out that silver's ratio to gold has been historically out of balance. For much of human history, silver traded at ratios ranging from 15-to-1 to 30-to-1 relative to gold. That means 15 to 30 ounces of silver equaled the price of 1 ounce of gold. In recent years, that ratio has been closer to 80-to-1 or even 90-to-1. Gold trades around $2,650 per ounce as of early December. If silver returned to even a 50-to-1 ratio, that would imply a silver price of approximately $53. A 30-to-1 ratio would suggest $88 per ounce. A return to the historical 15-to-1 ratio would put silver at roughly $177 per ounce. Whether those historical ratios have relevance in modern markets is debatable. Industrial demand dynamics today are vastly different from centuries ago when silver was primarily monetary metal. But the ratios provide context for thinking about what might constitute normal versus extreme valuations. And by those measures, $70 silver wouldn't be extreme. It would be a move toward historical mean reversion. Chinese demand patterns add another layer to this analysis. China is the world's largest consumer of silver for industrial applications, but it's also a significant market for silver investment products. Chinese investors have historically favored gold over silver, but that appears to be shifting. Reports suggest silver coin and bar sales in China have been increasing substantially. When a population of over 1 billion people begins shifting even a small percentage of savings toward a particular asset, the market impact can be enormous. Silver's total market capitalization is tiny compared to gold or major currencies. It doesn't take much incremental capital flowing into silver to move prices significantly. Trade policy uncertainty is amplifying these dynamics. Potential tariffs create timeline pressure. If you're an American manufacturer and you think there's a 50% chance that silver imports will face a 25% tariff in 3 months, what do? You accelerate purchases now. You build inventory before the tariff potentially takes effect. Multiply that behavior across thousands of industrial users, and you create a surge in demand that exchanges struggle to satisfy with existing inventory levels. The December timeframe is particularly critical because it marks year-end for most companies. Capital budgets refresh in January. Procurement managers want to hit annual targets. Manufacturing operations aim to fulfill contracts before year-end bonuses are calculated. All of that creates concentrated demand in a compressed time frame. If inventory is already tight, December demand can push markets into shortage conditions that take months to resolve. What happens if Shanghai Futures Exchange inventories continue declining at the current pace? At 40% drawdown in 3 months, simple mathematics suggests the warehouses could approach critically low levels by late December. Exchanges typically maintain minimum inventory thresholds to ensure orderly markets. If registered stocks fall below those thresholds, the exchange might face difficult choices. They could potentially restrict delivery, raise margin requirements, or take other measures to prevent a default scenario. Each of those actions sends signals to the broader market that supply conditions are serious. We've seen this pattern before in other commodities. Copper inventories on the London Metal Exchange dropped to critically low levels in 2021, and prices spiked above $10,000 per ton. Nickel inventories collapsed in 2022, triggering trading halts and emergency intervention. When physical commodity markets get squeezed, the price moves can be violent and unpredictable. Silver markets are much smaller and less liquid than copper or nickel markets. A supply squeeze in silver could produce percentage moves that shock people who haven't been paying attention to the underlying inventory dynamics. Russia's announced purchases add geopolitical complexity. A $535 million commitment over 3 years represents approximately 2.5 million ounces per year at current prices. That's not enormous in absolute terms, but it's strategically significant. Russia's move could encourage other nations to view silver as a strategic asset worth accumulating. If that narrative gains traction among central banks or sovereign wealth funds, the incremental demand could be substantial. Sovereign buyers don't care about short-term price fluctuations. They buy for strategic positioning over decades, which tends to remove supply from commercial markets permanently. The convergence of these factors, Shanghai inventory drawdowns, potential U.S. tariffs, Russian strategic buying, industrial demand growth, and London supply relief operations, creates a situation where prices could move quickly in December. Not because of manipulation or speculation, but because physical supply and demand fundamentals are genuinely tight. Markets can remain orderly for extended periods, even when fundamentals suggest prices should be higher. But eventually, physical reality asserts itself. When warehouses approach empty, prices adjust to attract new supply or destroy demand. There's no other mechanism available. The projection of $65 to $70 by the end of December isn't guaranteed. Market forecasts never are. But it's grounded in observable supply tightness, documented inventory declines, and logical industrial buying behavior in response to those conditions. Whether silver reaches those levels depends on factors that will unfold over the next few weeks. Additional Chinese exports could provide temporary relief. Slower than expected industrial demand could ease pressure. Or, alternatively, accelerated precautionary buying could push prices even higher than current forecasts suggest. What makes this situation fascinating is that the answer won't take years to discover. We'll know by December 31st whether this supply tightness translated into the price moves that current fundamentals suggest are building. Market participants are making decisions right now based on their assessment of these supply dynamics. Industrial buyers are either securing inventory or gambling that supply will improve. Investors are either positioning for higher prices or waiting for confirmation. And exchange warehouses are either stabilizing or continuing to decline. If you found this analysis valuable, hit that subscribe button right now because we're going to be tracking these inventory numbers and price developments throughout December. This could be one of the most significant supply situations in the silver market in years, and I'll be breaking down every major development as it unfolds. Drop a comment below and tell me what you think. Are we heading to $70 silver before year-end? Or will supply concerns ease before that happens? I want to hear your perspective on where you think this market is headed based on what you're seeing in the data.